In today's episode, I'm diving into the listener mailbag. I'll be answering questions like when to reduce risk in your investments, which accounts to take from in a divorce, and how to plan if your spouse is much younger than you are. So stick around for some great thoughts, strategies, and actions that you may wish to implement in your financial picture.
Welcome to the Your Life, Your Money podcast with Scott Searins, teaching you how to thrive in life, wealth, and retirement.
Welcome to another episode of The Retirement Show, all about your life, your money, and helping you reduce your taxes. I'm your host, Scott Searins, and my goal is to help you thrive in life, wealth, and retirement. And today's show is a mailbag episode. We've gotten some questions in. We're going to talk about when you should be reducing investment risk, questions about which accounts to take from in a divorce, and then the last question is a couple in which the spouse is 10 years younger, and so they're wondering about life insurance, long-term care insurance, what is the right thing that they should be doing. So stick around, lots of good questions, and we're going to talk about thoughts, strategies, actions. You might either find yourself in a similar situation or find something in the question and responses that you might be able to implement in your financial and retirement picture. Now, before we dive in, if you haven't yet, one of the things I'd love for you to do is check out our YouTube channel. There's a couple ways you can get to our YouTube channel. One is you can go to lifemoneyshow.com. Again, that's lifemoneyshow.com. We've got links on there that'll take you to our YouTube channel. And then also you can just go directly to the YouTube channel. If you go to YouTube and search Searins Financial Group, that's SIERENS Financial Group. Why am I leading you to the YouTube channel? Well, we've got a lot of great videos there to help you build wealth, help you reduce your long-term tax picture, keeping more of your hard-earned savings with you versus giving it to the IRS, and a lot of videos there just answering some common financial and retirement planning questions, all about 401ks versus Roth 401ks, 401k withdrawal rules. And one of the popular videos on there is 11 strategies to help reduce your taxes for high-income earners. So again, lifemoneyshow.com, click on the YouTube link. We've got lots of great videos there for you. Now, before we get into the listener questions, our mailbag questions, first I'd like to just go over this article here that I read on the internet. I thought it was really interesting. And of course, I'm going to relate it to our taxes and year-end planning. But the article here, and I'll link to it in the show notes, so lifemoneyshow.com. The article was Powerball winner will take home millions, but probably not the whole $2.04 billion prize. So maybe you saw in the news lately that there was the Powerball up to over $2 billion. But when you actually factor in that fun word, well, not so fun word, called taxes, the winner here is not necessarily taking home $2.04 billion. And I know what you're thinking. Why do we care about this? Well, I want to go through how they break this up, and you'll see how we can relate it to our own financial and retirement planning pictures and our tax pictures, because if the person who won the lottery here isn't paying attention, they could get a big surprise. So the lottery winner of the $2.04 billion has two options of how they can take the money. One is a lump sum of $997.6 million, or the second option of taking a $2 billion of annuity payments, I believe it said over 29 years. Now, let's just assume they go with the lump sum, and the article talks about that's what most people do. When they take that lump sum, the IRS is automatically going to withhold 24%, or $239.4 million. Leaving them with $758.2 million. Still not a bad day, right? Now, let's just say the winner of this Powerball, the winner of the jackpot here, they stop right there. They didn't get any sort of help. Well, they're going to run into a really big surprise. That surprise is that $758.2 million that they're still receiving, well, that's actually going to jump them up into the 37% tax bracket, not just the 24% tax bracket. So the IRS is actually, what's automatically being withheld is actually too low. And so since they jump up into the 37% tax bracket, they could have another $129.7 million due to the IRS. So if they were planning to go out and just spend it all right away, which unfortunately sometimes happens, they could, let's just say they did spend it all, they could have another $129.7 million that they have to fork up in taxes because the IRS didn't withhold enough from the beginning. So why do I bring this up and how does it relate to us? Well, let's just assume that maybe you got a large bonus payment at the end of the year, or you're somebody who has stock options and you're exercising a large amount of stock options or restricted stock units. A lot of the times when these things happen, the company that you're working for is just withholding the typical amount, the same amount that you've already been withholding. But if this bonus payment or these stock options push you up into another tax bracket, you might not be withholding enough, which could lead to then a tax surprise come the following April. So just like the lottery winner doesn't need to stop because the IRS automatically withheld some funds, same thing for you in your situation. If you get a large bonus payment, if you're exercising some stock options, or just in general, this is a really good thing to do. Make sure you do a tax projection before the end of the year and that you've withheld enough money by December 31st, so that way you're not looking at any surprises come next April when you file your taxes. With that, let's move into our mailbag questions. The first one comes from Marty. Marty says, I've always been an aggressive investor. I like to see my money grow. And at what age am I supposed to get conservative? Marty, this is a great question. This is a question that we see come from prospective clients all the time, or it's actually a question that they should be asking that they are failing to ask, and it could potentially hurt their financial or retirement future from an income standpoint. So here's the deal. Sometimes I feel that people wait until their actual retirement date to make themselves more conservative, which is too late. Why? Well, what if the market's to crash upon your retirement? Then you have to sell stocks while they're down to get the income that you need, and you have less shares to be able to bounce back up. So when should you get more conservative? And you know what? Here's the deal, Marty. I'm not actually going to call it conservative because that could mean a lot of different things to a lot of different people. Sometimes people think conservative is a 70-30 portfolio. Sometimes people think conservative is having a 30-70 portfolio. It's such a broad term. It really doesn't give us a good answer. So instead, I like to help people take a more strategic approach. Here's why, and here's what I want you to think about. Think about 2008, pretty massive market correction. And it took around 5 years for the market to recover, to get back up to the levels where it was before it crashed. So if you think through this, right, like let's say we've got another massive market correction like this, and you have to ask yourself, do you think a 2008 could happen again? Do we think it would recover faster? Do we think it would take longer? But let's just right now go with kind of that 5-year rule because 2008 was a pretty massive crash. So in my opinion, then, at 5 years out, you want to start carving off income that you're going to need in your retirement, and you're going to start carving this off in what I like to nickname is your war chest. That war chest being a pool of funds not subject to volatility of equities. For example, this could be cash, CDs, treasuries, bond funds, annuities. As you can see, it is a pool of funds, types of funds that are not subject to the same huge up and down swings that we see in equities or your stock funds. And here's just a quick example of how this would work. So Marty, let's just say in your retirement, you're going to need to withdraw $60,000 a year from your portfolio to be able to supplement your income and live the lifestyle that you want to live. Well, based again on this 5-year rule that I had created, but it's not really a rule. It's a 5-year thought process. It's a 5-year strategy. And if you want to be a little bit more aggressive, maybe you take a 3-year strategy. If you're a little bit more conservative, maybe you go 6 or 7 years. But let's just go with the 5-year strategy here. 5 years out, you would then take and put $60,000 into your war chest. 4 years out, you'd put another $60,000 into your war chest. So now you've got $120,000 total, because if the market were to crash, and based on our 5-year strategy, it would potentially take 5 years to recover. Well, if you're 3 years out, that means you only have 3 years to recover, and you would need 2 years, 2 of your first years of income in your war chest. 3 years out, add another $60,000. So that way, when you get to retirement, you've got $300,000 sitting in your war chest. That is 5 years times $60,000 a year. That's the $300,000 that you've got in your war chest once you get to retirement. Again, so that way, if the market were to have a correction or to have like a 2008-like crash, you've already carved off your next 5 years of income needs, allowing the equity side of your portfolio to bounce back up and rebound and recover while you supplement your income needs from that war chest, that pool of funds subject to not as much volatility. A lot of times I find that people do not put a strategy to the question that you asked. And when they don't put a strategy to it, sometimes they get too nervous, and in retirement they just go on a website, they go on one of the major custodians, and they just say, great, give me one of those conservative funds. And that conservative fund could actually put way more than 5 years. Maybe it puts 10, 15 years of money in your war chest. You might say, well, that's okay, because what if it corrects? Then I've got plenty there. But the problem or the trouble is that you might not have enough then on the growth side. And as we're going through right now, we're seeing some really high inflation out there. So the only or the best hedge, in my opinion, to inflation is having money in equities. And that's where the balance comes in. And I find sometimes too, people get too nervous. They're right at retirement and they put too much on the conservative side. So let's just think about this. If you're retiring in your 60s and if you live into your 90s, that means that your portfolio has to support you for 30 years. 30 years of cost of goods going up. 30 years of making withdrawals from those accounts. And if you have your money too conservative, you could put yourself in a position where you're going to run out. So having a strategic approach, back to Marty's question, I'm an aggressive investor. I like to see my money grow, but when should I start to get conservative? In my opinion, you should start considering this 5 years out to retirement, taking a strategic approach, carving off a certain amount each and every year, so that way you've got your war chest built up to retire in the time frame that you look to retire. So once you retire, you got your 5 years in there. Now, if you're more conservative, maybe you want to think about starting this 7 years out. If you're more aggressive, maybe you're just starting this practice 3 years out. But I hope you got the thought process here, the strategy in regards to when you should do this. And having that strategy also gives you that mental capability that when we're going through what we're seeing right now in the economy with this big dip, you say, hey, I'm not as worried about it because I've already carved off my war chest. The money that's fluctuating right now is my 5 year out money. I believe that it will come back up and grow higher than where it's at today in the future. Hopefully that helps not only Marty, but I think that's a question on a lot of folks' minds. And as you're approaching retirement, hopefully that helps you too. Let's move on. Let's talk about the second question on our docket today. Our question here is from Dana. Dana says, my husband and I are getting divorced and deciding how to split up our assets. He'll owe me about $200,000. I could take that from his 401k or just take that amount from cash in our money market account. Which account should I choose? Dana, thinking about this up front is super smart. Here's the thing. I find a lot of times when going through a situation like you're in right now or like a death or something like that, emotions can really take place. Emotions can get a hold of us, and you just want it to be over, so you just start splitting up the money without any sort of thought. But what you really need to be thinking about is, what will your after-tax split be? Again, I'm going to say that one more time. What will your after-tax split be? And Dana, here's what I mean. Let's start with the money market account. Dollars that are in your money market account are sitting in the taxable bucket, meaning all of these dollars have already been taxed. So if you were to take $200,000 from the money market account, you're actually going to have net $200,000. Now, let's talk about the 401k. Let's just say, let emotions take place, and you're like, you know what, just give me $200,000 from the 401k, and you work it out that they roll it into an IRA in your name. Do you actually own $200,000? Well, the answer here is it depends, but most likely no. The reason being is because the money in the 401k, if it's a traditional 401k, has not been taxed yet. Every dollar that put in, you got a tax deduction. So none of this money has been taxed yet, and when you take the money out of this bucket, all of it will add into your ordinary income taxes and get taxed at your ordinary income tax rates. So let's just say, again, emotions take place. You're like, give me the $200,000 out of the 401k. You roll it into an IRA. You're looking at your account statement. You're like, yep, I got my $200,000 right there. Do you actually have $200,000? Well, the answer is no. You have $200,000 minus whatever you'll owe in taxes when you take the money out. So your net here, your net dollar at the end of the day, is not $200,000. Now, let's add a third part, just in case anyone listening finds themselves in a similar situation, and let's throw in the Roth account. Let's say there was money sitting in the Roth account. Well, this would actually be the best area to take the money from, or to split money from. Reason being is because the Roth account, you've already paid taxes, so similar to your money market account, but the difference is money in the Roth account grows tax-free and can be withdrawn tax-free. And you might be thinking, well, wait a second, what about my money market account? Well, the money market account, you're going to pay taxes on interest, or if you invest that account in a brokerage account, you're going to pay taxes on interest or dividends. Where the Roth account, you get that tax-free growth, and all of the withdrawals that you make in the future would be tax-free withdrawals. So Dana, not letting emotions totally take over, thinking about this up front is super smart, and I hope as you go through the process, you've got a financial advisor on your side, you've got a tax consultant on your side, and one of the things I want you to think about is, what will your after-tax split be? And I think that'll help you as you go through your process. As I go through these questions today, I hope that you're finding value and benefit from the responses that I'm giving. Now, we've got one more mailbag question left, but before I dive into that, if you have a question on your mind, maybe I'm not tackling the question that specifically you're going through, or that's on your mind, or that you're wondering about your tax situation. And if you've got a question that you want me to answer on the podcast here, you can go to lifemoneyshow.com. Again, that's lifemoneyshow.com. Click on the show notes for today, and you'll see on the right-hand side there's an area where you can ask questions. Now, maybe you feel like your question is a little bit more complex, or maybe you're just looking to get a financial advisor on your side to not only just help you through your questions, but help you through your financial and retirement plan. If so, you can go to lifemoneyshow.com, click on Work With Me, and set up a 15-minute phone call. In this 15-minute phone call, we're going to talk about what's on your mind. I'm going to ask, how can I help you the most? If I can bring value and benefit to you, I'm going to let you know that, and we'll talk about the next steps in the process. Or if I recognize that you just need to go in a different direction, I'm going to also point you in the right direction. So lifemoneyshow.com, click on Work With Me. We start with a 15-minute phone call, determine if we can help you down your path towards retirement success. All right, let's get back to our mailbag questions. Our last question here is from Michael. Michael says, my spouse is significantly younger than me, and I'm guessing she'll outlive me by at least 10 years. Do I need life insurance on myself to be sure she's okay after I'm gone? Michael, we work with clients that are in a very similar situation to you. And you didn't tell me your age, but since we primarily work with people that are near retirement or in retirement, let's just make the assumption that you're 5 years out from retirement. Let's just break this down a couple different ways. The first way, let's assume that you've saved enough. What do I mean by saved enough? Well, meaning that based on the plan that you have, when you pass away, based on what you've saved up, plus your other income streams, Social Securities, pensions, rental income, whatever you might have coming in, that your wife would be just fine to live the lifestyle that she chooses or needs to live. So that means based on what you saved up, how much, if you were to pass away, your spouse, your wife in your scenario here, could go and take out of the accounts. She might have to take out more because she doesn't have your Social Security. Maybe she doesn't have your pension coming in anymore. But if she were to take out larger withdrawals, that she would be okay. Now, if that's the case, then there's no life insurance needed. Because life insurance is that when you pass away, it's a lump sum of money to help replace income streams. But if nothing needs to be replaced, then life insurance might not be needed. But what's the monkey wrench that could get thrown into this situation, Michael? The monkey wrench that could get thrown into your situation is not necessarily death, but it's a health event, specifically long-term care. A nursing home could cost $100,000 a year. Home health care could be $60,000 a year or more for full-time home health care. And of course, all of these costs could vary by region, and these are just estimates. So as you could see, let's just use that nursing home example. $100,000 a year, you could see how quickly this could wipe out a huge portion of your assets, then depleting what your wife would have to work with, meaning depleting what she'd be able to make withdrawals from to be able to live her life on. So you might be thinking, wait a second, Scott, you just told me not to get life insurance, but you're also talking about how my assets are being depleted. Well, in retirement, that's when you make that shift from life insurance to long-term care insurance. You see, what if you were to be in a long-term care facility, a nursing home, for an extended period of time? You're depleting your assets while, if your wife is just fine, maybe there's a lifestyle that she wishes to maintain. And that life insurance won't actually pay out until you pass away. So long-term care insurance is to help pay those nursing home bills, to help pay those home health care bills, helping to protect what you've worked so hard to save up, and then that way preserving that, helping preserve it for your wife while you're in the long-term care facility, also after your death. Okay, so that's our first way, our first thought process. The second process here is, what if you haven't saved enough? Meaning that when you die, you already know that your wife won't have enough money. In that case, yep, you need life insurance. Life insurance, you need to determine an amount to replace the income that your spouse would be missing at your death. And if you haven't saved enough, that amount might need to be a little bit more. And at the same time, you also might need long-term care insurance to help protect what you have saved up, even if it might not be enough, to protect what you have saved up, so that way your spouse can maintain a lifestyle in the event that you were to go into a nursing home. Michael, the process that I would recommend going about here is first determining your income plan and investment plan. How much do you need to live your life on? What would that look like if you were to pass away? Meaning, how much income would you have coming in for your spouse? And then matching up that with your investment plan. After those are all set, then I would look at, do you need more life insurance, or are you okay? So back to breaking this down. Have you saved enough, or haven't you saved enough? If you've saved enough, then looking at your plan to say, okay, can we afford long-term care insurance to protect our assets, to help protect our assets in the event that you were to need long-term care support? So hopefully that breaks it down to you in step by step. That's the exact process that we utilize when working with our clients. We don't just jump into life insurance and long-term care. We look at the entire plan. We look at that income plan first, understand all of the income streams, understand how much assets you've saved up, what will come in. If both spouses are alive, how much will be coming in if only one spouse is alive, and then take the next steps from there. I hope that you found today's episode to be of value and benefit. If so, and you're wondering how to keep more of your hard-earned retirement savings with you versus giving it to the IRS in taxes, if you're wondering when you can retire and how much you can spend in retirement, go to lifemoneyshow.com and click on the Work With Us tab. We start with a 15-minute phone call to understand how we can help you the most. If we can bring value and benefit to your overall situation, if there's a potential good fit there, we'll talk about the next steps in the process to potentially working together. If you don't necessarily need our help and services, but I can point you in the right direction, I'm going to take the time to do that as well. LifeMoneyShow.com, click on the Work With Me tab, and you'll see where you can set up a 15-minute phone call. Again, thanks for joining me on the episode, and I look forward to our next conversation to helping you enjoy life today and being financially confident about your tomorrow.
Investment advisory services made available through AE Wealth Management, LLC, AEWM. AEWM and Searns Financial Group, Inc. are not affiliated companies. Insurance products are offered through the insurance business Searns Financial Management, Inc. Searns Financial Group, Inc. is an investment advisory practice that offers products and services through AE Wealth Management, LLC, AEWM, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by Searns Financial Management, Inc. are not subject to investment advisor requirements. AEWM and Searns Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as a sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Searns Financial Group, Inc. is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Searns Financial Group, Inc. Bond obligations are subject to the financial strength of the bond issuer and its ability to pay. Before investing, consult your financial advisor to understand the risk involved with purchasing bonds.